First off, very good morning to you. Friday the 4th of November then, Non-farm Payrolls Day. Typically actually one of the more important days of the month from a traditional point of view, but actually I would say non-farms today is much less significant than probably what we're normally used to because of the inevitable political risk which is looming just a couple of days away. With that, the DAX future, you can see in the middle left chart, we're already on the back foot again this morning. And so the overriding, dominating theme continues to be, and I would imagine that to be the case, being driven by the very close running of the election polls for the US, indicating that we are in for an extremely tight run race. S&P, let me just show you the stats. I'm sure you've read them by now. The S&P 500, you can see here, the first 8-day losing streak that we've had since October 2008, so literally the collapse of Lehman Brothers. And putting it in context, if today is a down day, it'll be the first 9-day fall since 1980. Quite interesting though is actually of the top 20 longest losing streaks, this is actually the second shallowest in terms of actual percentage decline, with it being less than 3%. So actually, although we've closed consistently lower for multiple sessions, the actual percentage decline has been fairly minimal. We've only fallen, as I say, less than 3%, but nonetheless statistically becoming more relevant as nervousness grows, obviously, around the US election. On that point, a quick look at this chart, talking with Vas about it. Actually, I have to give a talk both today and on Saturday about the US election, and it's been the biggest pain in the neck because every time I try to produce slides, and I've sent them off for copies, this chart continues to rapidly change. Every time I look at it, what I'm seeing is the solid reds is creeping out, and actually that 270 kind of magic number on that defined dotted line there, you remember when I showed this to you probably a week or week and a half ago? I would say it was a light shade of blue all the way up to Iowa, definitely, if not Georgia. And now, given what's happened, given the fallout of this latest investigation into Clinton, actually Trump has managed to reclaim a lot of these very key swing states. Now, just running through these briefly, obviously you know Florida is the most important in terms of actual college electoral vote size. That accounts for 29. In terms of the size of the others, NH is New Hampshire, and New Hampshire is relatively small but still significant. They're 4. Nevada accounts for 6 votes. North Carolina, though, is a very influential and deemed to be one of the key swing states after Florida. You probably would have seen Obama going toe-to-toe with Trump, looking to cajole a kind of African-American vote yesterday. And North Carolina, though, is still leaning on the latest polls towards being Republican. North Carolina, as a size, in terms of its representation of college votes, is 15. Then, obviously, the key one, no Republican has gone on to become president without winning this particular area, and only one Democrat, JFK, has been the only president to lose that and still go on to win the presidency. So Ohio, statistically and historically significant, and Ohio, after Florida, is actually the second largest. It counts for 18 votes. All of these, you can see, Georgia as well, is a punchy size, but they're all erring on the side of Trump. Obviously, given that the size of California, 55 votes being so heavy hitting because of the size of the populace in that particular state, she has a solid advantage in that regard. Likewise for the state of New York. So she only really needs to pick up a couple of the swing states, i.e. Pennsylvania, Colorado, and then just those 4 seats in New Hampshire would actually tip her over the line. but certainly it's getting ever more closer, and the reds are slowly shifting to a complete 50-50 balance here. In terms of what the actual polls are indicating overall, even though some of the polls have been more tighter, the actual overall on the college voting system, so not the popularity vote, Clinton is still tipped at 66.2%. However, I'd say in terms of the national polling on the popularity level, they're probably neck and neck at this point in time. So one of the important things I think about trading today's session specifically is that it could be fairly quiet, as is normally the case on the morning of a non-farm release. You'll get an hour of a flurry of activity around non-farms, and then I would imagine going into the European close and thereafter this evening will be very quiet, just given the fact that no decent sized volume is going to be going through the marketplace ahead of such a big event. And obviously as well, people definitely would not be wanting to hold any type of open positions over the weekend, given the propensity for, I would imagine, more negative news flows on both sides of the parties to come out as their final kind of push to garner public support in the US. So definitely politics still, to coin Will's phrase, trumping economics at this point, and I would foresee that remaining the case all the way through until this election is done and dusted by next week. But even after that, we're still going to be looking at the aftermath, because obviously the Fed decision is not until the 14th of December. Going back to the charts though, let's have a quick look at the pound. Obviously this was the big topic of conversation yesterday. Had a good talk with Piers and some of the guys in-house about how to tackle these kind of bouts of volatility that we saw. And let me just highlight the two, let's say, sterling episodes. The first one on the Brexit vote, and then the second one on the hawkish Bank of England. One of the interesting things that Piers was saying about trading this type of, I'm talking more explicitly about the Brexit vote when the UK High Court made their ruling, was that we were looking at it, or looking out for it, at 10 a.m. in the morning. And actually, this wasn't like a piece of economic data when there's a precise precision time of when it hits the wires and it immediately comes out and the market moves. This was, we were waiting at least a couple of minutes. And in that period, you saw the liquidity dry out a little bit. The price action became extremely choppy, but there was blips of price action definitely biased to the upside. Then you had the ruling that went against the government, which is obviously a sterling positive. We blasted higher up to what was a high at that point in pretty quick fashion at 24.75, before then pulling all the way back, and then thereafter probably about 7-8 minutes then recommencing a rally. And what Piers was saying was about how to tackle these events was really, you've got two options. You're either ultra aggressive in the fact that you're any sign or any hint that you feel, whether, I mean really, I guess you're going off ladder movement and price activity on the charts to hint towards you feel that means that the vote's going to go your way, and you're in. So instead of being in on the confirmation of seeing or hearing the actual result, you're already in at the base of the move. Now obviously that's much higher risk, something which I would say you get more comfortable with experience, which is, as you've all seen by now with the way that Will definitely trades. A lot of the time you see him into a trade with that ultra aggressive technique, irrespective of the fact that often he's into the position even before the news comes out, because obviously the charts are going to move way before actually we hear what's on the squawk, because it needs to be digested by the analysts on their desk, seen, understood, squawked, transferred via the internet, out our speakers, we digest it. All of that in total may take 1 second, but 1 second, as you know, against an algorithm is a lifetime. And so actually, if you're not going ultra aggressive, the other technique would be to wait for the pullback, if you like. So this was the two circles here. I've just been told my screen wasn't shared correctly. So we had the first pop here was the Brexit vote. That was the second on the Bank of England. And the second technique that Piers was talking about was the more patient and more cautious one, which is letting the kind of spike occur, the initial washout of the most aggressive price activity in the first few minutes, and then identifying a previous either retracement point from a historical technical level, of which is then your next point to follow the prevailing trend thereafter higher. So obviously a few of the guys traded it yesterday. I think definitely a good experience either way, because it's these types of situations where as you go on, it's going to give you more confidence to be able to make that more aggressive decision as and when it's needed. As you know, that momentary hesitation makes all the difference when we're talking about microseconds, not seconds. Yeah, the second move obviously came with the Bank of England being more hawkish. That kind of dropping of the commitment that rates could go lower, kind of no real mention of that. Remember, the previous language was about the lower bound is just above zero, i.e. we could go lower. That was kind of removed in combination with the fact that they only have a limited tolerance for inflation, meaning that ultimately if it got to the point they would want to tweak policy in order to take action to tame inflation, and obviously that being a hawkish measure. I guess as well, when the pound starts moving like it has done, obviously from a slightly longer dated point of view, we've now broken really above that defined, I'd say, range that was dictating pretty much really the algo crash that we had all the way through till really yesterday. And so technically there's a bit of open air, and this is when I guess round figures start to come into play, and that was certainly evident yesterday. We kind of got to that 125 mark, and then the market booked some profit, and again overnight we've kind of crept up towards that level again. So I guess on the way up, on the ascent, 125 is kind of the next figure to look out for, and then on the way up, given the fact that there's really not too much here technically until really we get up towards that low of 128.06, which defined the low point of post-Brexit on the 6th of July. And so you've got a bit of open air. So probably the 50 and then the handles going up will be to watch for. On that regard, let's have a quick recap as well on what the situation is with this Brexit debate, because this has got a lot more to run, and I would imagine is going to be the most influential factor over the pound, probably more so than economic data, given the fact that we know inflation is going up, and we know that that probably is going to impede the economic performance of the UK going forward, given the uncertainty as we get closer towards triggering Article 50. So just reading out a couple bits out of the FT, because I think they summarise it quite nicely on a few points. We heard from the spokeswoman yesterday from the UK government, said we have no intention of letting this derail our timetable. So they're still at this point in time, and it's important that that's okay for now, subject to change potentially, but the UK government spokeswoman still saying that they're sticking to the end of March as the Article 50 being triggered. The government has said it will appeal to the Supreme Court, but if the Prime Minister loses for a second time, the action will move swiftly to Parliament. For now, it is thought unlikely that Mrs May will sideline Parliament by calling an early election to win a new mandate for her Brexit strategy. She believes the EU referendum gave her the mandate she needs and has promised to govern until 2020. Again, important this because there was a few murmurs flying around, which was really sparked by actually Jim Reid of Deutsche Bank, who you know. He was saying that actually he thinks that they're going to call an early election next year in 2017 in order for her to get more political power, let's say, and backing for them to have a stronger hold on the present powers that be. So when she negotiates with Europe, she's in a stronger stance. Actually, the spokeswoman of the UK government came out and said that's not the case, and they're not considering an early election at this point. The FT goes on to say, from Mrs May's perspective, the ideal solution would be to present Parliament with a simple, non-amendable motion, giving MPs a binary choice after a short debate on whether or not to approve Article 50. Given such a choice, Mrs May's team believe MPs from all parties would feel obliged to back the motion, fearing the wrath of local voters if they were deemed to have tried to block Brexit. Now, I think that's a really important point from a political standpoint, is that everyone's kind of thought, well, does this mean that actually Brexit doesn't happen? And I think that that's not the case, because politicians obviously do they want to do what they feel is the right thing, or do they want to represent the people of the area in which they're from, which is arguably the most important thing and why they're in that position in the first place. So irrespective of the fact that probably there's a large amount of Parliament, maybe more than the general populace in the UK, that would vote to remain, and that could tip the balance. At the end of the day, you would be, as a local representative, going against the will of what the people have voted for. So as an individual parliamentary member, that would be political suicide. Your career would be over, because you would just get ousted because you've gone against a democratic vote. So May's it's a bit of a game of a chicken, really, because Theresa May she knows this, but it's a very dicey game and comes with very high stakes, because if they were to actually test her on that, it could go severely wrong quickly. And if that happens, political turmoil in any country typically leads to nervousness, and that has a negative impact in terms of the valuation of financial assets. Finishing off with the FT, other points, they say but lawyers and cabinet ministers believe Mrs May is more likely to be forced down a much more risky and time-consuming route, introducing primary legislation that has to be approved in both the Commons and the Lords. The big problem for Mrs May is that primary legislation can be amended, and this means that MPs and peers could attach conditions to the approval of Article 50, including demanding that the Prime Minister publish her negotiating strategy. So overall, this just adds more complexity to an already very short 2-year timeline which they would have in order to renegotiate various other trade pacts and so on of world outside of Europe. So maybe not quite as positive, just given now the actual question marks about internally, politically, how does this unfold in our own country, which will create inevitably more nervousness, and that would be a pound negative. So although we had a positive yesterday, obviously it leads to the initial assumption of a softer Brexit. There's still a lot here to play out, and the more this gets drawn out, the more it becomes questionable about the ability of the ruling government at present to be able to execute their plan, and that creates market nervousness, and that could then negate some of this general relief rally that we've seen. And don't forget, the economic backdrop is still lower growth, is probably what's going to be seen likelihood for UK economy moving forward. Okay, so that's your kind of state of play for the pound. Obviously, still remain very vigilant for anything you hear on that regard coming out of the government. I think we've probably heard the most of it so far for this week, with US elections likely to dominate here on out. A quick look at another chart of interest though, and the VIX. I talked about this the other day. It jumped around 9%, I think it was a few days ago. Well, it's just ramped up again, another 14% yesterday. And if you look at the chart, we are coming up to, well, we're above 20. Remember I mentioned that yesterday, which was that kind of psychological risk barrier, if you like, of when the markets tend to get into overly cautious or very jittery mode. And that's evident obviously in this persistent move low we've had in equities, and with gold sitting back at the $1,300 level. The high that we had post-Brexit as a guide, that was marked up at 25.76. So we're currently at around 22 at the moment. The fallout of the most aggressive, violent moves seen in the wake of the Chinese volatility at the beginning of the year, we were up at 28, to give you a guideline. Okay, quick look at some other things to be aware of today on the calendar. The service PMI numbers this morning are really not too much to be phased by. These are final readings, and as such, the DAX sell-off that you've had this morning is not so much to the data, it's more to do with the just continuation of the uncertainty on the political front. Then obviously non-farm payrolls take centre stage. Remember, the time difference still in effect until the US clocks change this weekend, so that will be at 12:30. Now, just a quick look at what some of the bigger banks are going for. just to give you a run through, the consensus estimate today with non-farms is 175,000. Goldman's looking at 185, Merrill's 170, Barclays consensus, UBS consensus, Credit Ag 185. Morgan Stanley are slightly toppy. They're looking at just above the 200k reading. And they're saying if that was to materialize, then dollar yen should receive another boost, and inspired by steeper US yield curve, obviously probably likely to just only further cement at that point the probability of the rate hike occurring in December, irrespective of the nervousness over the election. Overall, though, I would say, as you can see, all of these numbers of these guesses of these major investment banks are very much around the median consensus. And I would say, really, even if the number comes out 20, 30, 40k below consensus, I still do not think that that's going to influence the Fed enough to pull back from what they've been conveying that they want to do in December. I think the only reading that you would need to get to that point would certainly need to be double digit, and I would imagine needs to be more like 50k below for it to then significantly start shifting this almost 75-80% priced in value for December. A couple of points here. We've had ADP, obviously, which came in at 147,000. We had an upward revision to the previous, but was actually softer than expected. The employment component of the manufacturing PMI jumped to 52.9 from 49.7, but fell to 53.1 from 57.2 in yesterday's ISM non-manufacturing. So when you're looking at these consensuses that have been building up, obviously it's these prior job data points that you look at in order to formulate that expectation, and I would say on the balance the data has been weaker than expected, i.e. indicating maybe there's a slight bias to a downside reading for today's NFP reading. The other thing as well, just to quickly finish off with the calendar, we're out of the blackout period now from the Fed meeting. Obviously, the 7 days prior to a Fed meeting, no Fed official is allowed to speak, and then 24 hours after the meeting, they're not allowed to speak. As is quite often the case, then once that falls away, you get a slew of speakers from the Fed, all looking to just rebalance the powers that be in terms of communication. But I think that the statement was really a bit of a non-event that we saw midweek. So I'm not expecting a great deal, even in spite of the fact that you've got 5 Fed speakers, I think 3 of which are actually voters on the FOMC. I certainly wouldn't disregard what they're saying. I'd be aware of the points of when they're speaking, which generally is all after non-farm payrolls, but not really expecting too much from that. Okay guys, so it's your morning briefing. Some continuation of general risk off tone, I would say, evident in the DAX being slightly lower this morning. The S&P's followed suit to a certain degree, but pretty sideways fashion. The actual movement now, I think, in the S&P has become, and probably will be, fairly sideways, barring any unexpected shocks. Certainly there is a possibility that a new piece of news comes out of a negative spin on Clinton, or in fact even on Trump, that could really shift the balance on these latest pollings, which pretty much is even Stevens at this point. And I would say just be mindful of any of those polls that are coming out. Yesterday we had a new ABC poll, a new New York Times poll, and they were actually slightly favourable Clinton, and the dollar did rally a touch on the back of that. So that's the type of news flow you want to be looking for. Elsewhere in the pound, keep an eye on that 125. We're coming back up towards those highs as I've been speaking of the overnight session at 24.91, and obviously 25 target from yesterday's Bank of England spike high. Okay guys, enjoy the session, and I'll see you in the chat room.